I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say, the reason I own this is the sucker's going up. And that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. And this is the kind of stock people like to own. This is the kind of company people adore owning. It's a relatively simple company. They make a very narrow...
Listen to this. Listen to this.
They make a 1 megabit SRAM, CMOS, bipolar risk, floating point data I/O array processor, an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip.
2,000 years later.
Peripheral bus architecture.
Yes.
What's going on, man? Welcome to the Money Flow Sunday service. Let's pause my man, Peter Lynch. I don't know if you know Peter Lynch. He's a legendary investor, ran the Magellan Fund. And Peter believed, like I believe, that individual people, average people, can become rich, wealthy. Depends on your definition of rich, but you can definitely have more, do more, and be more. In that anything these insurance companies, these mutual funds, these index funds, these family offices, these hedge funds, these private equity firms, these insurance companies, these family endowments, these mutual funds, these retail traders, investors, anything that they have, an 18-year-old in his parents' bedroom has with his phone. Sometimes people they'll say, well, you can't execute your order fast enough, man. It's not possible to compete with a high-frequency trader. And this here's the chart of Apple. All a chart is, there's nothing magical about a chart. This is just an ongoing feedback loop of data. It's just a visual representation of the value of this company. And so if you took basic valuing metrics, that there's a certain number of shares. Apple has a certain number of shares in the world, and each one costs $160.25. And this is, even that price right there is fractal. What you think about that? Purpose of church, even the Hells Angels go to church. I don't know if you know this, they have a mandatory weekly meeting. It's called church. The reason they call it church is when you say church, or I call it money flow services, back to the basics, the beginning. See, in order to make your trading work, you need to understand the game you play in. Meaning, I think the more you understood the history of the stock market, the mechanics of the stock market, how it moves up and down, the more you know, the better you could be as a trader, whether it be a day trader, swing trader, momentum trader, or buy and hold investor. And we're all playing in the same equity pool, man. So this, it don't even matter what it is, but this is the Dow Jones Industrial Average as by the ETF DIA. It's the diamonds. This is a composite average of 30 stocks. Right before I came on, where did I find those? Right here. I Googled them. What are the 30 stocks that make up the Dow Jones Industrial? Meaning, you could just buy these yourself. You could go to M1 Finance and you can create a pie, and you could create a 30 stock pie, and you go 1, 2, 3, 4, and you can pick all of these, and you could dump your money in, and it'll evenly spread your money across all of these. And now you created your own ETF, except your ETF ain't got no management fees, which could be a lot if you got $1 million. So if you buy this ETF, they've done it for you. You get an equal share in all 30 of these stocks right here. And you know them all. United Health Group, Goldman Sachs, little store called Home Depot, right? Microsoft, Mickey D's, Amgen, right? Visa, Caterpillar, Boeing, Salesforce, Honeywell, Travelers, American Express. Shit, some of these Buffett owns. He owns American Express. Apple. Buffett owns like $35 billion of Apple. People say to me all the time, are we on? We're live on YouTube, by the way, Sunday service. Hit like. Science to Get Rich says in the second chapter, second paragraph, the ownership of money and property comes as a result of doing things in a certain way. And those who do things in a certain way, whether on purpose or accidental, get rich. While those who do not do things in a certain way, no matter how hard they work or how able they are, remain poor. I write about these 30 stocks in my free ebook, chapter 10, entitled Dogs of the Dow. And a guy figured out in there, you can go read the story of it, but basically he figured out, he watched these 30 stocks right here. I got them all in a folder. Right? Nice, a lot of noise. And I follow all 30 of these. And you could do it very quickly. You just hit a button, scan through their charts, right? You come over here and click boom. Oh, no, yeah. Come on, man, you're not going to throttle me today, are you? And then we just come across and we could burn through them, right? We just start going through the charts, man. They are literally having a meeting right outside my door. And we could track all the stocks that are inside of this. Now, what are you seeing? Fractal nature of the markets, man. Like you're going to see all these fractal patterns inside of the market, man. And you can play with all of these things on a different level, however you want to do it at different sophistications. But this price will move. This is a window into that. And so where you see it closed is the value on Monday morning, 322. It's going to open and offset against that. And that's going to be part of that ongoing feedback loop. Well, here's what I figured out. Well, here's what Michael figured out. That the 10 stocks that do the worst tend to recover the next year. So when the oil stocks did the worst, a year later, Jesus Christ. They're literally shooting a video in front of my door. What are the chances I'm live streaming on YouTube and they decide to do live streaming in front of my door? What Michael figured out is if you took these stocks and you sorted them by dividend yield, the stocks with the highest dividend yield were the stocks that did the worst. The lower a stock goes, their inverse correlation to its dividend yield. So if this stock here at $3 and what is it, $32, whatever it is, if it paid a $3 dividend a year, you'd say it had a 10% dividend yield. Well, if it falls down here and it keeps paying the same dividend, the actual yield for any new buyers goes up, right? So what he figured out is the stocks that had the highest yield, the 10 stocks that had the highest yield, paid the highest dividend, and they tended to recover over the next year. And he found that as a pattern, man. So he went in and started buying them. That created the dogs of the Dow. I got a couple pages on that in my book. Well, as I came across that, I thought, wow, that's kind of cool. What I began to do, once I figured out the money flow, I began to follow them too. It's already a group of sorted and selected stocks. This is Amgen. Now watch what we're going to see. Not perfect, but I want you to see this. And then we'll get into the money flow here. And it's just a piece of the puzzle, man. And then coming down. We're going to save this. All right. So this has already been selected, meaning this stock is in the Dow Jones Industrial, makes it one of the top industrial stocks in all of America. And there's a makeup of them. Home Depot, Walgreens is in there. A lot of stocks you'll see me having picked up recently. Or not recently, but I'm adding to. Because as these stocks fall underneath that yellow line, big alert to me. This right here just tracks the average rando price movement of stocks. Stocks move up, stocks move down, stocks move up, stocks move down. But because there's all these big institutional players in there, they can't get out in one day. And as they do, it moves the price. So these prices swing way up and way down. What we can do, sit back, look for wedges, look for opportunities, or just take filters that have already been done. So this Dogs of the Dow that I have on page 10, if you go look, where are we at? Hold on, man. Check this out. What year is this? 2015 McDonald's price, $93. So in, what did I say, 2015. So when I wrote this book, we would own this stock then. Oh, they're going to throttle me, aren't they? I've been having this problem when some reason my local provider here, and they're trying to make me get a business account. You can't make me, man. I ain't going to do it. All right, let's take this back. Now, you would never know about this stock. This is a secret one. There's no way your mom and dad could have known about it. How could anyone in your family have known about McDonald's? It's one of the best kept secrets in all of America. So if we look, well, they're not going to let me, are they? If we look at this chart, come on, man, and we take this back because I want to make sure we're showing what we're in church, right? Let's see, 2015. Dog of the Dow stock, McDonald's. I'm on a monthly chart. Now, look at this. Look at this. Well, Gerald, I bought, no, I'm not going to do my voice today. But say you bought CVS. And it went down. And you said, Gerald, ever since I bought CVS, it's done nothing but go down. Okay, man. So over here, in 2012, the beginning of January, if you started buying McDonald's, that's going to be in my book the following year. Look, from 2012 to 2013, it goes down. But Gerald, ever since buying McDonald's, it's done nothing but go down. What am I ever going to do? Buy more. So what Buffett does is, if you looked in his last thing, it took him 7 years to buy his position in Coca-Cola. I know why it took 7 years. If you read my book, You Don't Have to Die Broke. The business cycle, interest rates going up or interest rates coming down, them jacking with the economy. Things are doing great. Things are doing terrible. These things run in cycles, called a business cycle. And it's going to take about 5-7 years, usually, to cycle shit through. You get a business idea and it's working right now. Cool. Holler at me in 7 years. When shit changes, are you still in business? Most people, about half right off the top, are like, no. Right, because you only had a one-cycle business. There's a lot of one-cycle traders. What do you mean? They're going to come in and cycle out. You got, how many cycles you got in you, bro? How long you want to trade? So the secret, listen to this. Listen to this. Net worth, Warren Buffett. Now, he's an outlier. A little creepy, too. Would you ever see him eating his ice cream? He's sitting there in a chair eating his ice cream worth billions of dollars, wearing the same suit as yesterday, eating a 99-cent ice cream. Probably got 2 for $1. With all the money in the world. And he's like, hey, you want to share an Uber back? So this is Warren Buffett at my age, 52. Uncle Daddy had $620 million. Now, guess how much that is short of $1 billion? About 40% short, right? So it's about 62% of $1 billion. You see how I figured that math out? You need a thousand trillion to make, or 1,000 million to make $1 billion. And he's got 620 of them. So he's pretty close to $1 billion, right? Right there, man. And if you go look at what it is today, there's a lot, man. 109 billion. That means since the age of 53, he's 99'd his money. 99x. 99x, man. Since 53. And I'll meet guys, they'll be like, oh, Gerald, I'm starting so late. You think at 37 I can still do it? Yeah, I think you could, bro. If you got the money flow, you got to get a system and a strategy. You got to go to church, man. You got to turn it into a religion. It's got to become part of your life, man. So as you do that, so what I began to figure out is I dug into stocks and I began to try to figure out ways, man. I'm looking at charts and moving averages, and I'm looking at this and that and options, and I'm looking at leaps and warrants, and I'm looking at trading like this and that, and moon cycles and astro signs, and if lucky things, support and resistance, oscillators, and if on Monday it opens 2 points past the high, but if you divide that by Thursday's last low and it's a full moon, you would place a stop on limit quote. And if that worked, flip it into a binary weekly option. I mean, you could do shit like that, or you could just do shit like, I'm gonna wait. And this is what I began to figure out, man, that price would move and it would flow. And it wasn't perfect all the time. It's like, well, it really ain't gotta be perfect, man. I'm just trying to do the best I can. So it would move. It would be like, it would come down and it would stop, and it would put in, you start to see it it would just stop. You could connect it. You could like draw a line you could take a crayon, draw a line. And what I began to realize, well, they already have names for that shit. It's called support. And if you think about it, through a ball up, where it kind of stops would be, gravitational resistance, and where it hit the floor and bounced back up would be, well, support, where it caught it. And it would just go bong, bong. And if you think of a ball bouncing, that's what support was, man. Support's a level which historically a price it's had difficulty falling through, and it's thought of as a level at which buyers tend to enter a stock, often referred to as support level. This can be referred to as a demand zone. And it's a place where maybe institutional investors, like let's look at Wells Fargo. Hold on. We're going to get back to what this has to do with Warren Buffett. I don't know why they do this to me. Wow, come on, man. Oh, man. You got internet, D? They only do it on this one page, though. I'm showing I'm still live on, God. All right, you can pause that. Okay, I was making sure you stopped it. I don't know why they do this to me. It only does it here, man. Such a weird thing. This is so weird, man. I kill Instagram, and it works just fine. Sorry, YouTube. This is part of my daily struggle is technology, streaming apps, connecting all this shit, keeping it working. Every time you turn around, there's like, something's changed. Look at this Wells Fargo. Back on track, man. And we'll see this chart's been putting in some beautiful patterns of just price movement. Right? You see them? This one was quick, though. Now we're coming into another one. If we go, and you're just looking at this price, this on a daily bar, each one of these bars, I'm using bars. You could just as easily come over here and make these candlesticks. And I don't know, I'm just not a candlestick person. But if we have them as candlesticks, the reds are down, blacks are up. We can see the open and the close. You see price just visually, it's just red, 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 red. It's just getting smashed, man. And we can, if we have a way of coming over here and trying to determine what is the value on this. And here, the simple ways, Morningstar, there's a lot of services you could use. You could research it. You could learn how to read books. And they have a star rating system, 1, 2, 3, 4. We're going to come back to that. All right, sorry. They say fair value on this is $58. We are increasing our Morningstar uncertainty rating on the U.S. regional bank coverage, excluding U.S. Bank Corp. and PNC Financial, to high from medium to reflect the increased uncertainty. So if you come into here, you're dealing with some uncertainty. So you as the investor, if I'm looking at this, okay, it's like, yeah, it's undervalued, but what if we find out that Wells Fargo has some problems? This number is going to come down pretty fast. So one way I could do that is to try to look for, potential bottom. Or if I own this stock, Buffett owns a lot of Bank of America. So if we're looking at Bank of America, oh, and by the way, look at this. Speaking of Uncle Daddy, Warren Buffett's salary was just $100,000 last year. That means most of you guys on here make more than Warren Buffett does. And he returned $50K. So next year, give your boss back half of it. Say, here, bro, I don't even need that much. Warren Buffett made $100,000 from his W-2 job last year, and he returned $50,000 to Berkshire Hathaway. He said, here, let me pay you for letting me have a job. Warren Buffett's salary of $100K last year, and he hasn't seen a pay raise in over 4 decades. He's worked for the same pay for 40 years. He's repaid $50,000 to Berkshire to pay back for his personal phone calls and postage stamps. Buffett's net worth exceeds $100 billion thanks to his ownership of Berkshire Hathaway stock. Modest salary is $100,000. Thinks Chris Johnson makes more than $100,000 a year. Me. Now here's the trick, man. That dude bought, you can go Google this. Where's it at? Oh man, did I not pull it up? So from the age of 52, he's 99x'd. Guy's like, I'm 37, Gerald. Do you think it's too late? Well, he 99x'd from the age of 53. What if you 99x'd? What if you only 50x'd? Man, I like to 50x from here. That'd be all right with me. Wherever you're at, 50x sounds better, doesn't it? So here's what I figured out, that as I watched price and I got into this thing, the stock market, come on, man. Come on, man. As I got into this, and I began to look at all the different fundamental analysis charts and different patterns, and I began to kind of just put it all together, man. Began to say, wow, if you have money you don't need, you can watch these patterns. And if you believe, well, fuck, look at that. 53, what does he do? He buys a bunch of shit and keeps it. Like that was his big secret, man. Buying good things. Well, if you come along and figure out filters for helping you do that, sort them. We got, where's the, did I pull up the one? Oh, I didn't pull it up. Thought I had it on here. It was the top 10 stocks in the QQQ, top 10 stocks in the SPY, S&P 500, top 10 stocks in the Dow Jones. Out of that, you got a little bit of overlap. But if you look at those stocks, it's an amazing assortment of stocks. And you read the money flow. And here's what my shit says. Stocks go up, stocks go down. And they do that sometimes for no logical reason at all. And a stock will come way down. And as we watch it, the only thing a chart lets us do is just have some visual, repeatable way for guys like me that aren't that good with math to see something happening. And we know when it does this, then I do that. And I just look for that pattern. So one of the things I look for is for the price of the stock to go undervalued. I don't want to buy it if it's overvalued. Do you? Listen.
You will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger mega flop or a smaller mega flop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports, they buy a microwave oven, they do that. They ask people what's the best kind of radar range, or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we're being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anyone could predict interest rates right 3 times in a row, they'd be a billionaire.
All right, you've heard me talk about that. He's one of the most successful investors of all time. And he's saying nobody can predict that. There's a lot of YouTube who think they can. It's so funny to me. They are so stupid. And you'll see video after video, why the market's going to do this, they are so stupid. They're lying to you to get you to click on the video. So your relationship with them starts with a literal bullshit statement. They cannot. If you knew it all, I mean, you're just making it up. You have no idea. And the reason I harp on that is that uncertainty is at the core of any investor or belief in the market. And I'm not talking trading there. Trading is trading what you believe, what you think is going to happen immediately. Shit, what happened there? I'm talking about what you're seeing happening right now. Come on, man. So as we went down this, I don't know a lot about IBM. And I'm looking at this, and I met a lady yesterday that worked for IBM, which made me pull up the IBM stock. And as I'm sitting here looking at it, just right off the bat, I'm like, oh, it's undervalued. Look, it's building out of stage one. It's below the 200. Everything crosses up. Yeah, this is a buy. I don't know anything about it. You think the lady working there knows that? I mean, she could know that. I don't know if she's following the stock that close. I don't know if she gets a little alert on her phone that says, hey, our stock just went under 132. Well, let me come over here and see. What's it worth? Hold up. I thought it was going to be a dog stock, but it's not now. All right, they got it fairly valued. Look at that. Huh. So, I mean, to me, unless I see a reason for it to go any higher, it's not a value for me there. If I owned it, that wouldn't mean I'd sell it, but I'm not getting excited to buy that. If I can find something that I think has a better rate of risk to reward on the price. Now, if you have a reason to believe this would trade at a premium, then maybe coming even is good. Home Depot doesn't often get even, and if it gets even, and you know the historics, you know you've studied the stock, and you know whenever it gets, you know, at an average PE for that's low. But for a stock like AT&T, man, it could go ridiculously low because there's no growth there. It's not growing. It's the same shit every day, and they operate on a very low profit margin. That's what he's saying. Once you understand these stocks and how they make their money, is it a utility or is it built upon new products, new ideas, new sales, innovation? You know, is Pepsi innovating soda? No, but if they can produce it cheaper and distribute it better, they're going to make more money, and especially if they expand their market, right? So there's different ways that companies make their money, but understanding them is a huge part of this. And if you go through these and look at, like, just in the Dow, that's a bank, that's a thing, that's a software thing, that's a fast food company, this is a pharmaceutical, that's Visa, this Caterpillar Industrial, these guys make airplanes, they create software, this is an industrial production, this is in travel and leisure, this is American Express, this is Apple Computer, Chevron, these guys make shampoo, more shampoo, Walmart sells the shampoo, JP Morgan, right? This is a swath of America, right? And that reflection, as you watch this, well, look at IBM stock compared to Wells Fargo. That's a big difference, man. So Wells Fargo is undervalued by 50%, massive drop, screaming underneath the 200. And if I'm looking at the money flow and I'm like, God damn, maybe I want to take a chance. Maybe I want to build something up over a little bit of time. Maybe that thing is causing other things that I like. MPW. Look at this big stage 4 down. Well, if I go and I think for some reason this thing is worth more, you know, I can start using my trader skills. So as a trader, when I'm watching a trade, I'm looking for price to stop, which means it stops. It's not very complicated. And I'm looking for the MACD or TSIs to start to get a little bit of a turn in them. Just a little bit, man. It's called the curl. Just a little bit of a curl. See it over here? Not precise. It's not an algorithm. It's me looking at the chart. And so as I'm watching price, I'm looking for that because that could be where it starts a stage 1. So as a trader or an investor, how do you want to use the money flow, man? What's your time frame? And look, that's the money flow, by the way. Man. What's up, Nick? Daniel. Yeah, Yahoo Finance, wherever you get your news. Get your news. A lot of ways. I'm partial my ways. I subscribe to Barron's. I subscribe to CNBC Pro. I wouldn't do that unless you got a little extra money. Letters. Mostly for entertainment. I don't even buy the shit some of them buy. I just like reading it, look at what they're doing. You know what I mean? I like seeing what other people are doing. Sometimes I'm just watching, well, what are they doing in their portfolio? Are they adding bank stocks right now? If they're adding and I'm adding, and I'm like, well, that dude's pretty smart. I'm using the money flow. Maybe we're buying it at a different time. Buffett's been adding to Oxy. I haven't been adding to my oil, and I've been honestly scratching my head as to why he's adding to oil. I just thought it was overpriced. And yet he has a lot more money than me. We already established that. At my age, he had $620 million, and that was like in fucking 83 or something. Since then, he's 99x'd. That means I could 99x, guys. I could go up 99% from here. That's fucking shocking. And if you go through and read this, so it's like, you think I have a better chance of doing that if I was to look at his shit or read his shit? Or not? Get what I'm saying? Maybe I need to watch less Grant Cardone and read more Warren Buffett. Just saying. I do try to watch and read that. And see what they're doing. And I mentioned Buffett in my book in there. Now, we just talked about support. So I've tried to cover a lot of things here today. And I try to cover what the money flow is each time a little bit different. It's this basic idea that I believe that over time stocks go up, asset prices go up. Not every asset, not every stock, but the general price drifts higher over time. Shoes will cost more. Cars will cost more. Houses will cost more. Stocks will cost more. Technology will lower the price in some things and disrupt businesses. And that's business, man. Capitalism evolves. So we as traders are just trying to play price volatility up and down, man. Up and down. If you're a day trader, that's it. Give a fuck about earnings or this or that. Price is breaking out, I'm long. If it's breaking down, I'm short. That's day trading. Or looking for repeatable patterns that you think you have an edge to trade against. That's day trading. As an investor, I'm making my money. Warren Buffett didn't 99x since the age of 53 because he got my course or because no, man. He did this through owning shit, consistently investing, staying on it, and doing it every fucking day. That's how he did it. And as he got better, he invested more and more. And look, here's his salary. Warren Buffett's salary was $100,000 last year, and he gave 50 of it back. You didn't see any pictures of him in Acapulco with his buddies, right? That's the difference. The reason he got so rich, man, is he invests all of it all the time. And he went all in a long time ago and never got out, man. So he's been all in on his own fund, all in, all the time. So whenever he thinks it's on sale, he's taking advantage of that, man. One way we can do that, because I'm not as smart as he is, but so what I can do is use reoccurring themes or patterns. I can look for stocks to get underneath that yellow line. That's simple as I'm flipping through that immediately. Then I can go, that alerts me to go dig a little deeper. Is it? What's going on here? Is it good? So if I was to put in 3M, it's way below it. And I go do research. And I say, yeah, it's actually undervalued. Cool. Why is it down? Well, Federal Reserve's fucking doing this and there's that, but company's doing okay. They should be valued higher, dividends safe, and they're working on this and that. Cool. And then I can sort through those in a particular sector and buy assets in that. And then they start paying me money. And as I watch them on these charts, not as a trader, but what am I doing here? We talked about, look at this on support. A price level which historically stock has had a difficulty falling below. It's thought of as a level at which a lot of buyers tend to enter stock, often referred to as a level of support. Also, a demand zone. Demand zone means when it hits that price, people want to buy it. Look at Oxy. Now, this is just on a daily. I didn't even go back that far. Look at this. Look at these zones. Someone is buying it every time it hits $57. It's probably a fund somewhere. There's a guy in a room. Every time this stock gets down there, he starts buying. And he's got a cutoff price. I'm going to talk to you a little bit tonight on my Instagram story about different stop unquote, stop limit unquote, trailing stop, percent. There's different ways to enter order. This order cancels that order. But these guys will build up positions over time. Well, shit, if his goal is to buy it at 57, that could take 2-3 years, man. What are you going to do if it runs up to 76? He's going to wait. And you're like, well, if it runs to 76, and it's like, yeah. It'll go to 76, come all the way back down to 58, and you'll be like, oh man, this stock sucks. And it runs back up to 76, and you're like, yay, I love the stock. And it comes back down to 77. You're like, oh, I hate the stock. And that's the relationship people have. What's funny is in CVS, I'm still up like 20%.
Considering there's not that many billionaires on the planet, it's very, I had logic, so I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82, when we had a 20% prime rate, with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market is going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rate's going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that. Now, I have to be fair. I'm talking about economics in the broad scale, predicting the downturn for next year or the upturn or M1 and M2, 3B and all these M's. I'm talking about economics to me is when you talk about scrap prices. When I own auto stocks, I want to know what's happening to used car prices. When used car prices are going up, it's a very good indicator. When I own hotel stocks, I want to know hotel occupancies.
So if you own a retail pharmacy shop, what do you want to know? What do you need to know, man? How many CVS pharmacies are there? What is let's pull it up. What do they think it's worth? CVS is significantly undervalued at a 35% discount. Fair value 113. CVS aims to be the most customer-centric health company in the United States, and it's spent over a decade positioning itself as a leader in healthcare services with acquisitions of pharmacy benefit manager Kmart and insurance provider Aetna, defining its strategic direction. CVS top-tier retail pharmacy, health insurer, and PBM franchise create the potential to improve health outcomes, even bend the healthcare cost curve for its clients ongoing forward, and the firm hopes to add more primary care assets to its equation. You ever read that? People who own CVS may not have read that. This is the chart of CVS. So if we go back here in 2011, I mean, look at it, man. Now, this was the great crash, and it fell from 35 to 15. It's a 50-something% crash, which most stocks did, right? And then we see it had this beautiful run up. And so at night, there were a lot of people buying the stock at $92. And then it fell from 92 all the way to like 45. So you have this 50% collapse over here. You had a 50% collapse followed by a 2 or 3x. And then you had this 50%. And so then it runs up, and now we're coming back down. And if we were to go look, and it says it's significantly undervalued. So if we pulled it back to the weekly, what am I seeing on the weekly? Well, it's way overbought there. It's way overbought here. It hasn't bottomed yet, though, has it? Technically, if we know how to read those indicators, that's pointing straight down. There's nothing about this that says it's done going down. So we go to the daily. It's just brutal, huh? Now, what if you got a 5 to 7 year timeline? What you might do is like, oh yeah, I got a 5 to 7, 10. Oh yeah, of course. Then you're down 40% and you're like, but I can't do 5 to 7 years now. The price dropped too much. So make sure when you do that, you got to settle that in your head, man. If you have a rule, here's the problem with, I'm not saying trading, I'm talking about portfolio management. If you're in the money flow, remember prices go too high and prices go too low. If you have a rule that takes you out of a stock because it goes too low, that means you also have a rule that never allows you to buy a stock that went too low. And that's a dumb fucking rule. Because the one rule means the other rule. If you would sell a stock that did that, it means you wouldn't buy a stock that did that. Why would you sell a stock if you would buy the stock? Does that make sense? So if you don't look for stocks that do that, that means when you own them over the next 5, 10, 15, 20 years, you're never going to use the ones that you currently own as an opportunity to do that. And that doesn't make any sense. So settle that in your head, man. Otherwise, you're not buying Ford at $1.50. You're not buying MFA at $25. You're not buying, dude, I can give you so many I've had. Look at this. This is where I lose all my friends. This is Welltower. This is in my book. You don't have to die broke. This stock here. Now look at it today. Or that's Wells Fargo. I'm going to say, God damn, I didn't see it fall that far. So look. Pull it back to a weekly. Now this was in my book now. When was the book written? 6 years ago? Look at this, guys. Some of you ain't known me this long. But it was $90, $20, $97, $55, $80. All in the last 2 years. Let's back it up more. Paying dividends the whole time, by the way. Look at this. Look at these swings. And this doesn't look this big because on the chart, the further back you go, it doesn't look that big. But this is $30 to like 10. And then it goes from 10 to 50. That's a what? 5x? And then 155 to 135. That's a 40% drop. From 135 to 65. That's a, 80% up. And then from 60 to 40. This is a monthly, so these moves look small. If we back this to a weekly, look at these swings, guys. But Gerald, I bought the stock at 82 in 3 months. It's at 57. What am I doing wrong? Warren Buffett calls me a lot and says that. Let's see. Does he ever text you guys? Does he text you guys like that? I got a text from him yesterday. He's like, Gerald, Bank of America has fallen a long ways. I think my share count was too large. And I say, why do you say that? Because I don't like it. Let's see. Is that too real for YouTube? See that move, man? $36 to $27. It's pretty big, dude. Now, what if you started here, you bought this breakout. This is a swing trade right here, right? You ran it up. Where's your target? Previous high? That is a successful money flow swing trade. And you join the money flow and you're in with me. Right? Let's turn this down. It drifts up. Then it goes from there to here. Gerald, this doesn't go with my YouTube look. Let's see. And then what if it stays there for like 2 years? You didn't know that happened? There's a whole fucking generation. See, Apparently didn't know that fucking happens because they all blew out on it. Tempted to sit on the sidelines. You say, how do you know? Because I lose half the membership every time it goes down. Where's the guy at? I wonder if you're on here. I was going to make fun of him, but I didn't because I figured he'd quit. And I said, he's like, yeah, I can't get into Discord. Well, when did you last log in? A month ago? Maybe you don't need to get into Discord. Tempted to sit on the sidelines during a market correction. Here's what you'd give up. I know, I'm so busy. The S&P 500 index enjoyed its biggest first quarter gain in the year since 1998, which made me wonder how many people missed out on this rally. The growth came after the index was walloped in the fourth quarter, with the index down 13.55% for that period. Surely thought of cashing out many investors' minds. Now, I knew several friends that blew out during the growth crash. Two of them because of leverage, two of them just got scared. Time in the market. JP Morgan Asset Management Retirement shows the impact of pulling out of the markets on your portfolio. Looking back over 20 years, Gerald, CVS Pharmacy has gone down. Looking back over the 20-year period from January 1st, 1999 to December 31st, 2018, if you missed the top best 10 days in the market, your overall return was cut in half. 10 days. Individual days accounted for most of the movement in the market. But it's been 3 weeks and my account hasn't moved. Here's how a $10,000 investment over a 20-year period does if the investor stayed in and out of the market. If they didn't, if they just left it alone, they'd turn 10 into 29. If they missed the biggest 10 days, they missed those 10 days. And they're not in a row, guys. They were out for 10 of the biggest move days. Look how much loss it is. It's only 14 grand of 29. Now, maybe you were out, missed those, and caught the bigs up. And that's what I'm hoping if we're trading now. That would be a different conversation. But guys, since I bought it, it went down. What am I doing wrong? They're selling the stocks, guys. So if you look at like MPW, why is this stock going down? Well, it's in the wrong sector right now. Same reason that JP Morgan is going down is it's in the wrong sector. All banking stocks, all high yield stocks, all interest rate sensitive stocks are coming down because of that. And the ones that are closer to the problem are going to come down extraordinary. So the closer to look at KRE. Look at this thing's been obliterated. And if you remember, I started buying, what was it, the other day. We're taking a shot. This is the bottom. I don't know if it's the bottom, but it's a bottom. So I want to buy this one. If we go down to do another one, shit, I'm going to buy that one too. I'm using this. I don't think all regional banks are going out of business. So I'm going to start to put money at risk, meaning this, I could be wrong. Maybe they all go out of business and it fucking collapses in this Great Depression. I guess I'd lose my money. But if I don't think that, and if I think some of those banks are just fine and they're all right and everything's good, then that you get paid to take that risk. Just like in the movie The Big Short, where he got paid to short the banks. This is where you're taking a chance that the banks are going to be okay. And that's called trading. There's people on either side of the trade. So people could have shorted it down and now covering, and that's why it stopped, is you got people covering. Well, along with people covering, you got people like me who are like, that looks a lot like a stage one. Let me get up in there. Look, got the crossover, everything's moving up. This is my pattern. So I'm a pattern trader, and this is happening in front of me. So if I'm trading, I could get in. You should have got in again yesterday if you got knocked out of SDDP. Unless you're like, oh, I can't pull the trigger again so fast. If you said that, come on, man. You got to gut check yourself about if you're actually going to be a trader or not. Can't get back in the next day. Let's see. But I need at least 48 hours to get my nerves together. Let's see. This is our box, right? If I lost 2 in a row, I would feel real bad. So everything's starting to cross over, and we're building out a box. But this is really far apart. If you've taken my course, Getting Started with Stock Charts, you know, refer to that as a broken family. It takes a long time for this to come together. It means I have time. So if this is the market or the bottom and it kind of works sideways, I get a chance to build this up. Maybe I could get 100, 200 shares. Maybe everything gets back, and over the next couple of months, we get back to $57. And I make 57. I turn $300 into 57. Maybe collect a couple of dividends. That's if everything goes good. What if everything goes bad? Well, we'll play it as we played it. And I said, if you were leveraging it and I'm following the money flow, still using fundamental analysis, I'm still using my intellect. I'm using my free time to look up. Remember, we went and looked at the ETF, the KRE, and we saw the top 10 banks that made up the ETF, and you at least read the names. So when you went and bought shit, you understood what banks were in that ETF. Did you do that? Well, if you go look on DPST, and I asked you, and I said, hey, what banks are in there? And you're like, I don't really know. I'm just clicking the button. You should go read and see what banks these are. So when you're watching the news and one of those banks comes up, you know it's pertinent to you. This would be a good, so if you got busted out here, a lot of people did. To me, you had it too tight, man. You had it too tight, man. If you're going to run it that tight, you got to get back in the next day. You know, I would have gave it a little room. That's why I didn't text you. Notice the, and I would have bought just a little bit. Finesse it. See how we're going sideways on this, the DPST? You got to get back in on that, man, immediately. Immediately. You can't have any of them, I'm afraid, what if it goes again? Like, immediately. You're fucking trading. Trade, man. Execute on it. There's not a lot of wee-wah. Like, if you're trading it, trade it. So if we're watching oil, you know, and you might do this tonight, man. Make a list of 6 to 8 things that you're trading no matter what. Like, it's not fucking optional. You're trading them. And if you do that, it's going to accelerate your ability to be a trader because you're going to be forced to trade. And you may think, well, there's nothing to trade right now. Well, just wait. And as these 8 things hit, you're going to be in trades, and you're going to find yourself in like 8 trades before long. So this is oil. Remember our big run we had over here was 60-something% using the money flow, understanding that price moves in 4 stages. I don't know where it's going. I don't know where the top is. I just know what it looks like during these stages. And if I'm a trader, I need bounce off points or bottoms that I can play off of. And so like we were doing with DPST, like go look at these other trades, look at them. Same thing you're doing. You're playing an anchor point. Now on that one, it kind of hits you because it came back down. Well, if the next day it comes back in, you get back in. You're trading that. And so otherwise you miss this, you miss this run up. And then what does it look like when it's topping out? Where are the indicators? What does the MACD look like? And so you start to see that picture. Well, go get 8, 10 things that you're going to trade all the time. You might have TSLL on there. We're just going to trade this fucker all the time. We want to be in every breakout. There's no situation where you don't get in this. Okay? You got to sell some things. You sell it. And look, this is the pattern. And as we watch it, we can value, is Tesla expensive? Is it, what is it? So what's this pattern right now? So there's people watching this right now. Listen to what I'm saying. You're in a stock. You don't even know what they make. You don't know what it is. And the only reason you're holding it is because some fucking ego tied up in that you bought it up here when you didn't know what you were doing. And now you own it down here and you don't know what you're doing. And somehow this middle means something that somehow if that comes back, you'll feel better about the whole situation. Now I feel like a winner. When you could exit that and bought over here, wrote it up, took some off, come back in here. Now you're doing the stage 1. You could consolidate a lot of stocks that you don't like, don't need, into a smaller list of things that you're going to seriously trade them. So if you rolled 5 stocks that you're down in, you didn't like, into here, And if they all stayed where they were, you understand the math that your money went up, right? And you don't have to make the 80% loss back or the whatever back in the same stock. That's ego, man. I mean, you could be losing at cards and get up, go have a drink, come back in an hour, feel like you got your head together, sit back down and start playing. You didn't need the same dealer, same people. Blow your mind? I guarantee you Warren Buffett didn't get there where we were just saying 99xing by holding on to some penny stocks. He doesn't know what they do because he didn't want to eat the loss when he could have rolled it to Google or Microsoft. Amazon is a buy right here. It's fixing to look at this. If we're looking at the money flow, what do you see? Let's pretend you know the pattern, or you do know the pattern. You got a stage one. Look at this breakout. Look at the RSI went extreme. It's like, sell some. You know that. You know we would. You don't even have to ask me. Come down. What? Same thing. There's a stage one right there. But now let me show you what happens here. That's the stage one, and that's the anchor point. Look what happens here. It breaks it. That's what DPST did. It broke it. So you get out. The reason you'll see me wait a lot, even if it breaks it, is a lot of times by the end of the day, it comes right back up. Cool. You know, then I didn't get stopped out. Do I run the risk of it going a little lower? Yeah, I do. So it just depends, you know. Is it undervalued? How's it trading? This is the 1.5 leverage of Amazon. It only costs $15, by the way. So $1,500, you got a $3,500 position in Amazon. And you can trim it and all that. So there's one for Tesla, one for Microsoft, one for, you know, it's a whole bunch of these. This one's still a buy, by the way. And if we're trading, we're trying to get what? Maybe $19. Trying to turn 15 and 19. And we got to stop. Yeah, that's trading. We got to be nimble on that shit, man. Can't take it personal. Look at TMF. On this one, this is a bond position for me, which means I'm not selling. I'm accumulating stage ones. And if you remember, I missed this one, and I bought this one, if you remember right. And I was mad about that. And we bought, and go see my newsletter. Why? They're buying below this 200, and they've been way higher. Could they go higher again? Yeah, I think. Why? It's just reversion of the mean. Back these up to the weekly. Even on the weekly, you got $13. It's 40, 50%. Back it up to the monthly. These are government bonds, guys. I mean, this thing could go, oh shit, sorry, wrong one. $9 to 40. Let's put the TLT so it's a little more. So the TLT was 160 at its high. Now that was up there. And it's corrected now down to 106. That is a massive fucking drop. Now, part of the reason that Warren Buffett's income or his investments 99x from age 53 to age whatever 92 he is now is because he doesn't do all the dumb shit that they have us do. Well, I'm going to be in a target dated fund so that it puts most of my assets into bonds as I grow older. Okay? Well, that's what happened to you the last 3 years. If you had put 40% of your income into bonds, you might as well just fucking left it in growth stocks. That was what happened. It went all the way back to the price you paid in 2012. Well, instead of doing that, Buffett's buying Oxy, American Express, Apple, See, he's not going, I'm going to do a target date fund where they move all my money in conservative annuities. That gives me 7%. He's not doing that. He's buying a swath of American stocks when they're on sale. He has his little parameters. I call it the money flow. When stocks set up undervalued on stage one, I'm looking to buy and then never fucking sell them. Just let them multiply and compound and give me money. And I just keep adding to them. Might trim them from time to time. Right? And look, it just goes up and up. And what we do is the exact fucking opposite. So when you like time, let's see this. If you miss the 10 best days, your average return will be about 2%. Yeah, where's the Now, I am actually interested in bonds now. Why? Because I can get 2012 prices. So if you said, hey, do you want to buy some houses from 2012? Well, yes, sir, I would. Would you like to buy some gold from 2012? Why, yes, sir, I would. Let's see. What would I could pay for gold from 2012? Not much more. Look at that. Wouldn't be much cheaper. That's funny. That was a bad pick, huh? Maybe Bitcoin. What would Bitcoin be? Well, 2015, it'd have been 156 bucks. I'll take that. I think you get my drift, though, is that over time, these things go up, man. Find a very simple strategy to tack into, man. Understand these 30 stocks of the Dow. Read my Chapter 10 ebook. You understand those 10 stocks, and then you understand the money flow. You understand how dividend works. Just that simple strategy is just uber. I mean, I met a kid the other day. All he's been doing is that for a couple of years now. So think of that. This year, Amgen, big dividends. Chevron, big dividends. It's now on sale. Dow, 6%, starting to go below the 200. IBM, big dividend, is below the 200. Intel, well, it just hit the 200. JP Morgan's at it. 3M, what else we got? Merck, these are all great, man. Verizon, we've been buying. Walgreens, been buying. You see why I'm buying Walgreens? Because I wrote it in a book. Like, go read it, man. So I'm going to stay with it, man. I don't need a YouTuber or any guys on Reddit or any of that book. Like, I'm doing me. I'm doing what I've seen work throughout all of history. So as I studied the stock market, like, listen to this guy.
Chemical stocks, I want to know what's happening to the price of ethylene. These are facts. If aluminum inventories go down 5 straight months, that's relevant. I can deal with that. Home affordability, I want to know about that. When I own Fannie Mae, or I own a housing stock. These are facts. They're economic facts and it's economic predictions. And economic predictions are a total waste. And interest rates, Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He can tell you what short rates are going to do in the next 6 months. Try and stick them on what the long-term rate will be 3 years from now. They'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? So I think that's, but you should study history. And history is the important thing you learn from it. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine. You're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. So I think that's another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor. You're not sure this Walmart can make it. You want to check. You see them operate in small towns. You're afraid they can only make it in 7 or 8 states. You want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money, but you could have waited 10 years after Walmart went public and made over 30 times your money. You could have waited 3 years after Microsoft went public and made 10 times your money. Now, if you knew something about software, I know nothing about software. If you knew something about software, you would have said, these guys have it. I don't care who's going to win, Compaq, IBM. I don't know who's going to win Japanese computers. I know Microsoft, MS-DOS is the right thing. You could have bought Microsoft. Again, I'm repeating myself, stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time. People are in an amazing rush to purchase a security. They're out of breath when they call up. You don't need to do this. You need an edge to make money, too. People have incredible edges, and they throw them away. I'll give you a quick example of SmithKline. This is a stock that had Tagamet. And you didn't have to buy SmithKline when Tagamet was doing clinical trials. You didn't have to buy SmithKline when Tagamet was talked about in the New England Journal of Medicine or the British version, Lancet. You could have bought SmithKline when Tagamet first came out, a year after it came out. Let's say your spouse, your mother, your father, you were a nurse, you were a druggist, you're writing all these prescriptions. Tagamet was doing an amazing job of curing ulcers. And it was a wonderful pill for the company because if you just stopped taking it, the ulcer came back. See, it would have been a crummy product that you took it for $1 and it went away. But it was a great product for the company. But you could have bought it 2 years after the product was on the market and made 5 or 6 times your money. I mean, all the druggists, all the nurses, all the people, millions of people saw this product. And they're out buying oil companies, or drilling rigs, It happens. And then 3 years later or 4 years later, Glaxo, even a bigger company, it's a huge company, a British company, brought out Zantac, which was a better, at that time, an improved product. And you could have seen that take market share, do well. You could have bought Glaxo and triple your money. So you only need a few stocks in your lifetime. They're in your industry. I think of people, if you'd worked in the auto industry, let's say you're an auto dealer the last 10 years. You would have seen Chrysler come up in the minivan. You've seen, if you're a Buick dealer, a Toyota dealer, Honda dealer, you would have seen the Chrysler dealership packed with people. You could have made 10 times your money on Chrysler a year after the minivan came out. This is the Taurus Sable, the most successful line of cars in the last 20 years.
That last part, man, if you don't know who Peter Lynch is, you better recognize. A little study on him this weekend. And Peter, I had this on my story where I went walking and there was a dude over there painting. And when I first went out, there was a guys working in my street and they were on a John Deere. And I looked at it and I just looked at the chart and then let me show you what I saw. And we'll wrap up church in just a second. But what is it? Let's look it up. And this, you can go see it. I forget. It was maybe a year or so ago. This is the chart of Deere. And it went from $20 to $460. And I was shocked by that. I mean, I know, but I don't know. You know what I'm saying? I actually have one of their products at my house. And to show you how money is all around us, and there was a guy working on it, and I went over there and asked him, I said, man, how long you been doing this? And he said, man, I've been working on these for about 15 years. Every day? He's like, every day. Digs hole. I was like, you own any of the other stock in that? He was like, what? I was like, you own any stock in that? He's like, no. Guys, go back 15 years. And what's funny is if you go back 15, and it's not his fault, but I want to illustrate a point here. You could cherry pick it and say, well, God damn, he could have bought it in 2009, the bottom, after the crash, and rode it from $20 to $460. He's using it 6-8 hours every day. Never occurred to him this. But the reality is, if you go back 15 years, it's actually back further, and it actually runs up here, and then you have the great crash of 2008, and it was up, I think, over 100. And I wonder if he'd have been a guy, if it had been you, I don't know, maybe if it was you, and it fell from 100 to 30, if you're not going to feel like you did something wrong. Oh, my portfolio's red. I've done something wrong. And yet, all the stocks went down, guys. Like, it wasn't just yours. It wasn't just your picks. All the stocks went down. So that's normal movement of the markets, right? But he wouldn't have been happy. He'd be like, oh, my life savings. And then we see that pain point was the best opportunity for anyone. And it would have been for him too, even if he had owned 10,000 here and it fell to 3. I mean, the best thing for him was another 10 and then rode it to 460. Made himself $1 million. But instead, I mean, he didn't even look down. Like the ticker symbol, he's sitting on it every day. It's crazy, man. And I wonder, are you sitting on some ticker symbols? Every time I get in an Uber, I ask them if they own shares, you know, if I'm alone, and they always say no. It's, why are you? It's kind of dumb, but okay. I mean, he doesn't know, man. But the rich man is keeping me down, Gerald. It's like, no, your knowledge is keeping you down.
Ford went up 7-fold on the Taurus table. So if you're a car dealer, you only need to buy a few stocks every decade. When your lifetime's over, you don't need a lot of 5-baggers to make a lot of money starting with $10,000 or $5,000. So in your own industry, you're going to see a lot of stocks, and that's what bothers me. There are good stocks out there looking for you, and people just aren't listening, and they're just not watching. And they have incredible edges. People have big edges over me. They work in the aluminum industry. I see aluminum industry is coming down, inventory is coming down 6 straight months. They see demand improving. And America today, you know, it's hard to get an EPA permit for a bowling alley, never mind an aluminum smelter. So you know when aluminum gets tight, you just can't build 7 aluminum smelters. So when you see this coming, you can say, wait a second, I can make some money. When an industry goes from terrible to mediocre, the stock goes north. When it goes from mediocre to good, the stock goes north. And it goes from good to terrific, the stock goes north. There's lots of ways to make money in your own industry. You can be a supplier in the industry, you can be a customer. This thing happens in the paper industry, it happens in the steel industry. It doesn't happen every week. But if you're in some field, you'll see a turn, you'll see something in the publishing industry.
Happens in the real estate rental industry. AG&C. Start to understand the mechanics behind interest rates affects it, how it goes up and down. Real estate REIT O. If you own real estate, you actually understand how this works, how their rent collection works, how they borrow money, how they manage properties, where those properties are located. It happens in MPW, it's commercial investing. So if you do what I do for a living, buying old houses, fixing them up, meaning inside of my own industry of what I do for a living, there are stocks, there are banks. So I've built my real estate empire using regional banks. Right now, regional banks are setting up for, do I think they're, my bank's fine. It's your bank, man. Call them and see. That's what he's talking about. And you're going to see this week after week, month after month, going forward the rest of your life. Just all of these setups, these things that where if you have the right mindset and you understand how prices move, and you understand that over time markets go up, and when you see disruptions in price point or the ability, like he was talking about Ford, but I've owned Ford forever. My experience, every time it comes under this line here, but then back it up. I mean, look over here where it fell from 9 to 4. It was pretty challenging, but that's no different than from 24 to 12. 50% is 50%, man. This one wasn't any easier than this one up here. Right? They're both 50%. right? I mean, that's 50%. $25 to 10, and then look over here to here. Different time frame. Well, yeah, different time frame, different price value. A house 10 years ago appreciates 10%. It's the same house today appreciating 10%, right? So, but here's the thing. What if you had bought it here and you wrote it up to here and you took a little off and it pulled back to here? Like, that doesn't mean anything. But if you bought it here and it ran up, now it comes down to here and you're kind of sad because you're underwater. But it's like, no, you just got on the roller coaster, man. You just got on the bus, and it's a cycle, and it does the business cycle, periods. And you got to figure out, if you're building out a portfolio, you pick up different assets along different paths of the cycle based on different setups, man, and you manage that shit. They're going to tell you you can't. What Peter was telling you back then is you could, man. You have an edge, actually.
Come along, and it's just mind-boggling. People throw it away. One of the things I find a rule, a couple of rules I want to throw out that I find useful, excuse me, is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100. People said, here's this great company, great record. If it ever gets below 100, just buy every share. And it did get below 100. A lot of people bought on that basis, saying, look, it's gone from 135 to 100. It's not 95. What a buy. Within a year, it was 18. And this is a company with no debt. I mean, this is a company that was just so overpriced. It went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange at Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now unfortunately, this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel. They sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it got to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? Psychiatrists haven't worked so far. I've never seen them running in. The psychological psychiatry fund, I've never seen this for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer. That hasn't worked. So if you don't understand the company, you have this problem when they go down. Eventually, they always come back. This one doesn't work either. People think RCA just about get back to its 1929 high when General Electric took it over. A lot of double nits never came back. Remember those beauties? Floppy disks, Western Union. The list goes on and on. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, I'm thinking of buying the stock at 3. How much can I lose? Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money. Everything. And people say it's 3, how much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0. And they're selling short at 7, they're selling short at 6, at 5, at 4, at 3, at 2, at 1.25. And you know to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go? You know, the important thing is you can't get too attached to a stock. You have to understand there's a company behind it. You can't treat this like your grandchildren. You have to deal with the stock and say, I understand the company. And if it deteriorates, if the fundamentals slip, you have to say goodbye to it. If one rule you want to remember is the stock does not know you own it. This is a breakthrough. So don't get, you have to understand it and say they're doing well, and as long as they keep doing well, my best stocks have been my 5th, 6th, 7th year I own them, not my 5th, 6th, 7th day. So you have to understand that and stay with it. And then I'll switch through to my my long shots. Avoid long shots. I bought about 30 long shots in my life. I've never broken even on one. The ones that are really bad are what we call whisper stocks. And,
Right, man. Hope he got what he was saying there. It's good stuff. Stock doesn't know you own it. Attached to that dumb stock that you're down 60% in and you think it needs to go up is you. Nobody else in the world even thinks that or gives a shit about it. You get what I'm saying? So if you own some stuff and you don't know what it is and you're down in it, it won't know. You'll be the only one. Take that money and roll it to stuff that you like now or you know now. You probably know more now. You could roll up out of it and sell out. I run into a lot of people with that hang up. And it's like, you can cut it and let it go. You could have done that. Man, we've had a lot of trouble with Intel. I'm hung in there with this stock. Ain't nothing wrong with cutting it, moving. You're like, you know what? AMD's just killing them. I'm the kind of guy that would take half, buy that, and then start building the other position and give this longer. That's just my nature. But I would definitely sell half of a crappy penny stock to buy Amazon or Tesla breaking out. You get what I'm saying? You're allocating money to shit that can work, and that's called being a trader and pivoting. And utilize that, man, and understanding the difference between that and a good company just having troubles versus a company in trouble. Big difference. All right, man. Hey, I appreciate you guys. If you don't go subscribe to the newsletter. I don't send out a lot of emails, but if you're not on the email list, you won't get one even when I do it. I don't use AI. That's for people who are too stupid to write. They use it. If you come over here and click that at the bottom anywhere, you can subscribe to it. I put out a little Telegram group yesterday. I'm just going to open it from time to time. We're just talking stocks in there. Ain't no big deal, man. If you can't keep up with Discord, you don't need to be in that. That's playing around, talking about stocks, memes, shit like that. Usually late when I should be sleeping. I'll open it from time to time. Don't DM me about getting in. I'm not going to let you in like that. You just got to see it when I drop it, and then I'm going to close it. I opened it a couple hours yesterday, and we had about 100 people pop in. So it's free. It's fun. No fighting. Don't be stupid. We're just talking stocks and things like that. If you see it, you want to do it, jump on. Again, it's not a big deal. Appreciate you guys, man. I hope that helps with you the way you see the picture. Go research Stephen Lynch. We'll close out with him talking, but Peter Lynch. Go check him out, man.
If Arthur Levitt was here, we'd appreciate these stories. But these are the times that somebody calls you up and say, "Hi, Peter. How's Carol? How are the kids? I'd like to talk to you about International Blivet." And what they have in this company is very good about the earnings. Earnings going to be very small.